Hello and welcome to the Her Retirement Podcast. I am your host, Lynn, and here in my podcast each week, I talk about how to live a better, more intentional, and financially secure life now and in retirement. Whether you're single, suddenly single, or a partnered up woman, your only sure investment is an investment in yourself. And financial wellness, also known as financial security, isn't just a dream, it's a decision. And when you decide to make a commitment to yourself and change your financial destiny, our fresh, modern platform will help you know more and have more now and in retirement. Welcome to Her Retirement. Welcome to my Know More, Have More financial wellness platform. And welcome to my podcast. Are you ready to get her done? Let's do this. Hey there, and welcome to this week's episode of the Her Retirement Podcast. Today, I am joined by Brian Saranovitz of Your Retirement Advisor, and Brian is pretty interesting individual as he focuses on retirement planning. And also what makes him interesting is he is my life partner and my business partner. And I hope you bear with me as the recording of this podcast is being done from my vehicle as Brian and I drive across the state of Georgia to a business trip. And I have Brian captive, so I have an opportunity here on this week's podcast to pick his brain about what is going on in the market. So welcome, Brian, to the Her Retirement Podcast.
Hello, and thanks for having me. And there's not much I can do because I am captive and driving down the highway here. So I'll do my best to be able to multitask, drive at the same time of giving some, hopefully some good insight as to what's going on in the market today.
Is that like scratching your head and rubbing your belly at the same time?
Yeah, that can be very difficult for most individuals.
All right, so let's give this a whirl. Let's see if Brian can really dig deep into some ideas and thoughts on, just kind of trying to put our fears aside, because we are all a little fearful right now, admittedly so, and with good reason. There's a lot going on in the world, and some of us are kind of taking a peek at our retirement savings and getting a little stressed as they see those account balances falling. So Brian, what's your perspective on what's happening in the current market as it relates to people's retirements, and those people that are, maybe you have some ideas for people that are closing in on retirement or just in retirement. And then after, we can talk about people that are maybe 10 or 15 years out from retirement. But let's start with those people that are kind of closing in and are like, oh goodness, what do I do?
Yeah, well, first of all, let's say there is a number of situations that are impacting our economy and our stock market and even our bond market today. We all know the horrific situation in Ukraine. I think that has a definite effect on the market. And because the market, with any kind of uncertainty, not knowing what direction that's going to head, any uncertainty is not good for the market. So that's one of the reasons why we see the stock market moving down. But then ultimately we also have hopefully the endings of COVID, and we're opening things up. There's a lot of demand for products. And there's limited supply at this point in time because people are getting back to work, and that's driving, supply, demand, high demand, lower supply. That always is not good for for the market and for inflation. That from a pure economic standpoint, that drives inflation up. High demand, low supply. So I think, and then of course you add in the Ukraine situation and the political environment and the government just printing money. There's a lot of pressure right now on the market. So we all have seen our 401k balances, IRA balances going down. Typically, what we do is we have a traditional portfolio, and I've been talking about this for a long time. We have a traditional portfolio made up of 50% stock, 50% bond, 60% stock, 40% bond. We've all heard the 60-40 portfolio for people retiring within the next 5 to 10 years or in retirement. That's traditional.
Okay.
And the one thing that we usually see is what protects our overall retirement portfolio from high volatility, which is bad when taking withdrawals from a portfolio.
I know.
What is that, Lynn?
Bonds.
Exactly, bonds. And that's what I've been preaching and talking about in classes over the last 5, 7, 8 years since we've built our retirement planning classes, is that bonds are not what they used to be. And what I mean by that is that bonds with the very low yields that we've had on the treasuries and even corporate bonds, as interest rates rise, I've been talking about this for a long time, your bond values, bond funds lose value. So as we've seen, and what I've been saying is we need an alternative to these bonds at this point in time. Because over the past 5, 7, 10 years, where bonds have generated a 4 to 6% return over the years, we're seeing a 1 to 2% return over the past 5 to 10 years in bonds. And actually, over the past 2 years, we've actually lost value in our bonds. And why? Because as interest rates have risen in the Fed, has increased interest rates over the past 6 months, 8 months, and it's going to continue, is what we're hearing. We've lost more in our bond funds this year, in our portfolios, than we have in the stock market. And this is one of the first times we've seen this. But as interest rate hikes and the Fed continues to increase interest rates, we're going to see a continual downturn in the bond market, in your bond portfolios. Bonds have lost over 12%, depending on the type of bonds and the longevity of your bonds. If you've got longer term bond funds, you could have lost 20% so far this year.
Okay, so we've got two parts of the equation here that we have to look at. So part one is focusing on bonds. How do we stop the bleeding, right? How do we stop the bleeding in bonds? And what are the alternatives? That's part one,
yeah.
Right? So that's probably the most immediate thing we need to look at and figure out a solution.
Yes, and that's what I've been saying,
okay.
Exactly.
Okay, so what are those solutions or opportunities?
I mean, the first thing is that, from that perspective, we still need 50%, 60% of our portfolios, our retirement portfolios, 40 to 60%, let's say, in stocks, because stocks give us inflation protection.
Okay.
So I would say you should still stick with that percentage, 40 to 60% of your money in globally diversified stocks.
Okay.
That's inflation hedge over the years. But that 40 to 60% sitting in safe money bonds, what used to be safe money bonds, those you should be looking at things such as structured investments, structured products.
Okay.
These are products that have been developed by investment management companies, investment management banks, and insurance companies. There are 3 levels. And ultimately what they are is you're actually linked, your returns are linked to the market, the stock market. It could be the S&P 500 index, could be the Russell 2000 stock market index, Euro stock market index. You're going to get a percentage, what they call a cap, over the next year or two on that particular investment index. But on the way down, if the market goes the opposite way over the next year or two, depending on your contractual obligation with the insurance company, the investment company, or the investment bank, on the way down you have protections like a bond historically has given you. And those protections can be 0% worst case scenario over the next year or two. It could be minus 10% worst case scenario over the next year or two in that particular index that you're linked to or running parallel to, or could be as much as a minus 20%. And there's many different variants in between. All I'm saying is these structured investments can be designed so that it gives you a good upside of the market return growth while protecting the downside as a bond historically has done. And the overall return of these things, these structured products, structured investments, and you got to be careful with which ones you use, but the most important thing is that they can give you a tremendous boost in growth when the market's up, while giving you some great protections while the market's down. So I think that's very important. I think that's to me, that's the number one alternative, potentially, to
the bond dilemma.
to the bond dilemma, to the dilemma that, if interest rates go up, you're going to lose more money in your bonds. And the other negative to bonds right now, and this is a key piece right now, and I've been telling everybody this as a word of advice, is if you have 40-50% of your money sitting in bonds, intermediate term bonds, long-term bonds in your portfolio, or bond funds, whether it's Fidelity, Vanguard, T. Rowe Price bond funds, does not matter. My words of advice right now is to take that portion of your portfolio and put it into a money market bond fund. Put it into a money market mutual fund in your 401k, or a stable value fund of some sort. Because you're just not being given enough upside potential in those bonds for the risk that you are assuming right now.
Okay, so I'd literally go into my 401k dashboard, portal, whatever you call it, and I would just move my monies out of bonds into a money market fund, as 401k providers give you that option.
Or a stable value fund or something like that.
Stable value fund.
And I always tell, it can be difficult to know what fund, because once again, bond funds are not all created equally.
Okay.
You just want really a ultra short duration bond fund in this market environment, because, as I said, if the market, the bond market is not going to increase over the next year by more than, even if the Fed does not increase interest rates, the bonds typically are not going to yield any tremendous upside returns, where the stock market could, because right now we're seeing the stock market is negative, down 12, 13, 15. The Nasdaq's down 20% this year off its highs year to date. So, but with the stock market, the reason I'm saying hold tight in the stock market and that percentage is because stocks, this could turn around like what happened in COVID. We could see a 30, 40, 50% upside in the market over the next 6 months. Nobody really knows.
Okay.
I'm not counting on that, but that can happen. We have great upside potential for your downside that you're assuming, for your downside risk that you're assuming. Bonds just don't give you that upside.
Okay, so as far as the other side of the equation, stocks, we should just stay the course. Like, don't panic. Just stay in your current allocation. If you're 50, 60% in stocks.
Yeah, I'm saying I think that's a reasonable. As a rule of thumb, everybody is different. So, but as a general rule of thumb, 40 to 60% in stocks, and on the other side, the converse side, 40 to 60% in bonds or safe type investments that we talked about, or money market funds temporarily. Now, the one thing I don't want you to do is sit in those money market funds for the next year, 2, 3 years, because they're going to gain nothing.
Okay.
So they're great for protection, but they're going to gain nothing. So that's why you can always give me a call, and I can show you some alternatives to that side of the equation. Some of these structured investments, and there are many different types. There are some, as with everything, I don't care if it's a mutual fund, I don't care if it's an annuity, I don't care if it's a life insurance product, whatever it may be, or stock. There are the good, there are the bad, and there is the ugly. And you want to make sure that you're definitely not in the ugly. You don't want to be in the bad, you want to be in the good. And there's a big difference between, a high quality, structured product and something that's not going to give you much juice, as I say, or upside potential.
Yep. I remember talking to a woman who said, one of the biggest mistakes I made was in 2008, I pulled my money out of my 401k. So I know you're going to say that women should not, women listening to this podcast should not panic and pull their money out of their 401k and put it in the bank.
Yeah, I think that there's no reason in the world at this point to panic. I don't think there's ever a reason to panic. Just before the COVID, you remember, Lynn, I put together a webinar. And one of the things that everybody always says is that, this is an unprecedented. Mm-hmm. This is an unprecedented event. COVID was an unprecedented event. And during that period of time, for a 1-month period, from February 19th to March 23rd, the market went down 34%. 34%. You would have lost a third of your stock market portfolio in the beginning of COVID. if you had panicked and pulled your money out, you would have locked in that loss. Whereas for the individuals that stayed the course and stayed tight and didn't panic, the market went up over 60% the next 6 months. So you would have made back your money for 2020, plus the market ended up about plus 17% for the year. So the point is that's called a V-shaped recovery, very quick recovery. So I'm not saying that the average downturn in the market takes about 2 years to get down, not a month. And it usually takes about 2 years or plus to get back to point A. But the point is, what you want to do is you want to be properly diversified, as I said, with stocks, maybe some bonds, and some structured products of some sort. And then you don't have to make any knee-jerk reactions when the market's down. And of course, when the market's up, you're still going to get some really good upsides. So the moral of the story is, at this point, there is never a reason to panic. Because, once again, what goes down in the danger with this in retirement is that, closing in on retirement, you don't want to see a third or half of your portfolio to be gone due to market conditions. But once again, there is never, as I said, every downturn in the market is an unprecedented event.
Well, I have a question.
And the thing is, in what I'm saying, with these unprecedented events, whether it's COVID, whether it's the junk bond crisis of 2000, whatever it may be.
Well, I have a question.
The market always rebounds.
Yeah, I have a question for you. How long has the average market downturn lasted?
Typically, when we look at the last 100 years of data, and I have this, I wish I had my slide in front of me from our class, but from memory, I mean, it's approximately about 2.5 years it takes to get from peak to trough in a traditional bear market, in a true down market, about 2 to 2.5 years. Okay. That's the average. Okay. And then to get back to point A, it's about another 2 to 2.5 years. So the average downturn in the market from peak to trough back to peak to get your money back is typically around, let's say 3 to 4 years.
Okay. So what if I was planning to retire in January of 2023? What should I do?
Yeah, I think that's the reason. Like right now, if you've got to look at your portfolio, number one, and I run a very sophisticated portfolio analysis for my clients and students that want to partake, and we want to see what percentage of your portfolio right now is in stocks, what percentage is in global stocks, domestic stocks, international stocks, small caps, so on and so forth. So how is that diversification? What does that look like? Are you properly diversified on the aggressive growth side, which should be 50 to 60%, typically? And then on the other side of it, what type of bonds do you have in that portfolio? Are they junk bonds, meaning below investment grade bonds that are very, very aggressive and can be good? They're a part of a portfolio, but how much of that do you have in your portfolio? How much do you have in government bonds? Are they long duration, short duration? So that's the point, is that we need to look at all of these factors. You need to look at all these factors to understand exactly what risk you are assuming within your portfolio. And then once again, once you assess that, then we can make an educated decision as to how we should restructure that portfolio to be, as I think you say this, Lynn, to be, and I would say, retirement ready. Okay. Retirement ready. So when the market goes up, you take advantage of that. When the market goes down, we're not going to eliminate downside, but we're going to mitigate downside properly and efficiently.
Yeah. So do you have a lot of clients calling you panicking right now?
Just every day, hundreds. No. I really don't.
And why do you think that is?
Well, I would say this. The reason I do not, and I talk to a lot of associates that I know that are advisors, and they're using traditional strategies, and like I said, the bonds are going down with the stocks, and that's not good. There's no protections right now in a traditional portfolio, so they're getting a lot of calls, and they're getting panicked clients, so on and so forth. I use, as you know, Lynn, we use a I would call it unconventional strategy, not traditional strategy, but it's much more efficient. And one of the things that we do is when we combine stocks, maybe a little bit of bonds, diversified stocks, a little bit of bonds in those structured investments, we have really quelled a lot of risk out of the market. And we also, with every client, run some pretty sophisticated retirement projections with all of their stuff baked into that equation, including Social Security, inflation rates over the next 20, 30 years, so on and so forth. And then we run it against the worst market environment, that projection, and the best market environment, and many market environments in between. I call it my retirement stress test projections, retirement projections. It's a very sophisticated system. And ultimately, my clients know when we build a portfolio, that portfolio and that mix with their Social Security and any pension income is going to make it in the absolute worst market environment we can possibly envision. So this is a very minor blip right now compared to the way we run a analysis and different portfolio structures to make sure that a client can make it in the worst case scenario. Because once again, market environment. Because if you can make it there, you can make it anywhere. And that's important.
Yeah, it's almost like having a storm shelter, or just this. What did they have back in the days of the? Those guys that had the shields, and they, the arrows couldn't penetrate them. Like a suit of armor.
Yeah.
It feels like having a suit of armor, and so you don't have to panic because nothing's going to penetrate it and kill your retirement.
Yeah, because if you know that we've run your stuff with inflation and everything else, some pretty sophisticated retirement projections in the worst case scenario, and we've built a portfolio, a retirement portfolio, in that, looking at that market environment over the next 20, 30 years. If we encounter that, you're still going to make it. That's giving you that shield. You're right. That's giving you that shield to know that. And that's why I'm not getting a lot of calls. Okay, that's why I'm not getting anybody that's really panicked, because they know that in the worst case scenario, they're going to be okay. And this is just a minor blip right now.
Right.
Now, it could get a lot worse. This could get a lot worse.
Yeah.
But nobody knows.
Yeah, so people may have to reconsider their retirement plans, perhaps, like continue working for a little bit longer. If someone's like 10 or 15 years out from retirement, would you say that this is kind of like a good wake-up call to say, you know what, if you get to the point of retirement and you're in a down market, it's a good heads up to say maybe you need to have a pot of money that you rely on during these down markets so that you don't have to be pulling up money out of a portfolio that's going down.
Well, I think this should be, this absolutely at this point should be an absolute wake-up call to anybody that is, especially somebody that's 5 years to 7 years before retirement, 2 years before retirement, or if you've just entered retirement over the last 5 years. I think this is a definite wake-up call, because once again, if anybody, I don't care who it is, I don't care if it's the greatest market economist in the world, or your retirement, or your investment advisor that you're working with, or you go online and you listen to someone on CNBC or Fox or whoever it is, an economist comes on and they say, oh, this is the market's going to be going up, don't worry, da 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 da, or whatever, or they say the sky is falling on the other side of it. Don't believe either one, because nobody knows where the market is going to be heading in the near term. We do know in the long term, over the next 5-10 years, the market will have some really good upsides. But in the short term, over this next couple of years, I don't know. Nobody knows if the market's going to go down another 30 or 40%. It's happened before. Not
recent history.
No, recent history it has, but it doesn't happen every day. But ultimately, what I'm saying is the market could go down 30, 40% from here. And it also could go up 30 or 40% from here. The market, I always say, is schizophrenic. We just don't know.
So we just have to do what we can control. Focus on what we can control.
What you can control is your allocation and your risk control mechanisms within that allocation. And that's what I'm saying, is I think that unconventional wisdom instead of stocks and bonds, stocks and some alternative type investments, such as structured products, so on and so forth, that we know exactly. We can structure them so that, if we want a minus 5% worst case scenario with 30% or 50% or 70% of the upside of that particular index, we can get that structured and put that in as a great bond alternative to goes much higher upside than downside. So that's one thing we control, but we don't control what goes on in the market. But if you control the things that you can control, ultimately, there's nothing to fear. There's nothing to fear at all in this market or any market.
Awesome. Well, thank you, Brian, so much. This has been amazing. So thanks, Brian. That was an awesome explanation of what's going on and helping our listeners of the Her Retirement Podcast maybe feel a little sense of calm, understanding what's going on in the market and some ideas. And it's very, very important if you are closing in on retirement or trying to make that decision of whether you can retire this year, next year, the following year. Really, really important to get a retirement income projection analysis done. Brian Saranovitz at Your Retirement Advisor can offer that. He does it all the time for students, clients. Helps you take a look at that projection and where you might end up as far as your retirement income. And also, as he mentioned, the portfolio allocation. How is your retirement savings allocated? How should it be allocated? How could it be allocated for your future? So I always like to say at the end of my podcast, it's all about getting her done. So take some action. After you listen to my podcast episodes, I always tell you to take some action. So you can reach out to me at lynnt@herretirement.com if you'd like to connect with Brian on that retirement income projection. There's no strings attached. He runs those. He talks to you about what his findings are, and then you can make some educated decisions, more informed decisions. It's all about knowing more and having more. Thanks for listening. Thanks, Brian. I'm glad we stayed safe here on I-95 heading to South Georgia. Until next week, y'all have a good week.
Thank you.